All right, ladies and gentlemen, welcome back to another YouTube video. In today's video, we're going to be going over how to properly approach the markets as a beginner trader. Now, there's a lot of people in my server that are always wondering about basic concepts that I've went over in the past, but I'm going to dedicate an entire video to this one concept. And the basics are going to consist of here what's shown on this flowchart. So first off, we're going to be starting by understanding the basics. So to start out, I only trade on NQ for futures. Now there is rare times that I'll trade gold, but typically I'm only on NQ. So that's really all you should be worried about right now. All right. So first things first is going to be chart optimization. So when you open up your trading view, it'll probably look a little something like this. You'll be super zoomed in and you won't be able to really see what's going on with price. So what you can do is you would drop it off of the daily time frame. As you can see up top, we have these minutes here. The 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily. You can do really whatever time frame. That is basically just a representation of how long each one of these candles is. So if I were on the 1 minute, that means each candle here is 1 minute long. And if I was on the 15 minute, each one of these candles would be 15 minutes long. Now, these candles are a representation of what the current price of what the NASDAQ is buying and selling at, because at the end of the day, all of this market is an auction. It is buyers against sellers. So there's no need to overcomplicate it. So now that you understand what you're looking at on your chart, the candles that represent the current price, we're going to get into how we can freely navigate our charts. So first things first, on the right side, you can either drag up or down to make your price taller or skinnier. And then you can also hover over the background and zoom in or zoom out to get a better view of what you're looking at. Now, for your chart, you're going to want to be going into your indicators and adding this right here. Search up ICT kill zones and pivots by TFO. That'll be a good indicator for you to use. And then on the left side here, you have your toolbar. So you don't really need to worry about a lot of these. You have things like trend lines, you have things like long and short positions and text, everything like that. Stuff you don't really need to worry about. So typically, I'm on the 1 minute unless I'm getting a bias, and I like to be able to see a good amount of price action behind me. So I'm able to kind of get a good direction on where the market is going. Um, so you don't want to be overly zoomed in like this or super, super tall like that. You want a good happy medium between tall and wide so you can see a good amount of price action. So now that we've got the chart optimization out of the way, we're going to be getting into take profits and stop losses. So what is a take profit and what is a stop loss? Basically, what a take profit is if I were to enter a sell position right here and I had a take profit at this level on the NASDAQ, which is at 26,115, as you can see over here. Whenever price comes down into this level at 26,115, it would exit me out of my position for the profit. Now, the same thing for the stop loss applies. If I were to have a stop loss here at 26,176, if price were to come up on this sell position and hit this price or hit this point on the chart, that means my position would be exited out, closed out for that loss. So essentially, these are important because you want to always have a stop loss because you don't want to enter a position and it just fly the other way and absolutely liquidate your account. Same thing with the take profit. This is where your target's going to be. You don't want to let price run infinitely and not have a take profit and then it goes and reverses on you. So that covers take profits and stop losses. So now that we've gone over optimizing our chart, how to size it correctly, and what's going on around here, these tools, everything like that, and we've went over take profits and stop losses, we could get even more basic. So what this is a candlestick. Now, sticking out above this is called a wick. So the entirety of this thing is a candlestick. This is considered the body, the inner area that is shaded, and then the lines that protrude from it are considered the wicks. So that's another basic piece of information if you don't already know that. So boom, now that we've gone over what a TP and stop loss is and what a candlestick is, and we now understand how to optimize our chart, how to open the app and navigate it without being confused or feeling like we are in an airplane cockpit. Let's move on to contract sizing. This one is important. Now, like I said, I only trade NQ. Now there's two different pairs to every futures pair. There is micros and there is minis. So for a NQ mini and there's NQ micros. Now, NQ mini contracts. So first things first, before we get into the sizing of a mini or a micro, we're going to understand the difference between ticks versus points. So a tick would be if my price of the NASDAQ, let's say for example, went from 25,000.25. If that went to 25,000.5, this would be considered a tick right here. This is one tick. So there's four ticks in 1 point. Now, 1 point would just basically mean price of the NASDAQ going from 25,000 to 25,001. That would be 1 point. Now, one tick and 1 point. Do we understand the difference between these two now? Awesome. Now let's get into what the NASDAQ's contract pricing is now that we know the difference between ticks and points. So, on an one NQ mini contract, whoops, on a NQ mini, one NQ mini contract, now 1 point. Now, one NQ mini contract is $5 per tick. Now, if we apply that same logic that we just learned right now, that there is four ticks in 1 point, that means that each point value on the NASDAQ is going to be equal to $20. So if let's do some easy, quick maths here. If the price of the NASDAQ was 25,000 when I sold it, and I ended up exiting my position at 24,000 24,950. 50 times 20, that is 1,000. So do we understand how we got the $1,000 here? Since four ticks is equal to 1 point and 1 point is equal to $20, $20 times 50, 50 points, that would equal my 1,000. So now that we understand what one mini contract does, let's get into the micros. So one NQ, one NQ micro is going to be 50 cents per tick. So that would be 50 cents per tick. Or in 1 point, that would be $2. So four ticks that equal a point. 1 point on a micro would be equal to $2. So now, do we understand the difference between the sizing of a mini contract and a micro contract? Should be simple enough. Micros are a lot smaller than minis. Minis are about 10 times bigger. Um, I do recommend for the newer people that are just learning the strategy to start out by trading on a micro and using micros. And that ticker would be called MNQ1 instead of NQ1. So you would be trading on the MNQ pair because that is for the micros. So those are the smaller contract sizing. That way you're not blowing your account and you're not overly risking without knowing really what you're doing. So now that we understand contract sizing, let's get into our next big oh let's get into our next section, which is going to be over here. So next up on the list, we have risk management. So now that we know how to navigate our charts, now that we know what a take profit and a stop loss is, and now that we know what a candlestick is, as well as knowing the difference between the contract sizing and what a point value versus tick value is, now that we understand the difference between these two, let's get into the risk management portion of it. So, for risk management, this is the strategy I always follow. So, anytime I enter a trade, whether it be a buy or a sell, I have a stop loss of 12 and a half points away from entry. So, I always have a stop loss of 12 and a half points away from my entry and a TP of either 50 points or a session high or low, which I will not be going over in this video. I've went over it in different videos. Um, so what you could do is, let's say, for example, I had a sell right here. I could just drag my stop loss to 250 negative $250 because 12 and a half points will always be negative 250 on one NQ mini. Now, if I were trading MNQ, if I was on one micro contract, 12 and a half points away would be $25. So it's basically divided by 10. So either way you're looking at it, you can either drag it or you can use this forecast tool here or the projection tool of the short. And this tells you up top, you see where it says stop 26.75. Just put this line wherever your entry is at and then drag your stop loss to the 12.5 points away, and you can drag your stop loss up or down into wherever that is. Now for the take profit, I always have it 50 points away. And then you can also drag your take profit if you're on sells or buys down or up to that projection box to help you guide where your target is going to be. Now, there should never be a confusion with risk management because there should never be a difference in what we are risking. No matter what the contract size, no matter what you're trading, you always have the same point amount of stop, or that always have the same point amount away from your entry. So there should never be any confusion about your risk management or anything like that. So now that we've covered risk management, how much to risk, and it's pretty consistent. There's never really anything that changes with that. We can go over trade management. Now this one is important. So now that we've gone over risk management, let's go over trade management. So typically the rule that I follow is either whenever my trade goes 1 to 2 or 1 to 3, depending on the setup, I move my stop loss from 12 points away to break even. This removes the risk from the trade. This is a measure to take just in case price comes down and goes into profit, or goes up and goes into profit, and it doesn't fully hit your take profit and it reverses on you. If you get stopped at break even, it's a no harm, no foul trade because you're risk free. So anytime my trade goes 1 to 2 or 1 to 3, I'm at break even. This means since I'm risking $250, my 1 to 2 would be $500 in profit. So if I'm on one NQ mini contract and my risk is 250, that means my 1 to 2 RR would be $500 in profit. Does that make sense? So I move my stop loss to my break even point or my entry point as soon as I'm up $500, or you can look at it as 25 points in profit. Either or, $500 or 25 points. So this is just a pretty general rule of thumb for managing your trade position. There's really not much else to do. While you're in your trade, this is the only thing I would be doing. I'll get into trailing your stop loss and extending your TP in another video, but this video is going to be more for the basics. So as far as trade management and how you should be managing your position, this is it right here. Anytime you get 1 to 2 R, you're going to want to go break even. So 1 to 2 R would be 25 points in profit or $500. So now that we've gone over trade management, let's go over the psychology. And then we just have 2 more sections of this video and we will wrap it up. So let's go into the psychology of trading. So let's say I'm on a fresh 50K account in a beginner's case. So you'll be starting on a 50K account. Typically, the rule of thumb that I always say is if you win your trade, if you make money, take that and run until the next day. There's no reason to be entering more and more setups after the fact because you're just risking your profit. Now, what I like to tell people always is to minimize market exposure at the same time as maximizing your profits. Very, very, very important. Write this down somewhere. So the trading, so a little bit more. So let's say I'm on a fresh 50K account and I take a loss for negative 250. If I take that loss, I need to be in a clear headspace before I enter another trade. The reason why 99% of traders fail is because of over trading and revenge trading. It is the number one thing that liquidates people's account faster than anything else. The way these prop firms are designed are made to make you fail your account. So whenever you fail a trade, you need to take a second, reevaluate, understand why that trade went wrong before you go and enter in another setup. Revenge trading, it has got me, it's got your favorite mentor, it's got the biggest celebrity. Anybody that trades has experienced the feeling of revenge trading and FOMOing into a trade. This is extremely bad on your psychology and your prop firm account. You're just going to liquidate yourself if you're sitting here over trading and revenge trading. If there's no setup to be taken and you're just trading off of trends, you're gonna blow your account. If there's a setup that looked good and it did not play out, it could just be it's not the correct session profile you're in, or you're just perceiving the markets wrong that day. You need to take a step back, take a deep breath, reassess, and reevaluate. This is gonna save you so much money. So much money. The best way of making money most of the time, not most of the time, sometimes is actually not trading. If you're sitting here just pressing buy and sell after a loss, you're going to just keep pissing away your profits. So that was kind of, it's pretty brief. There's not much to the psychology of it. Um, Journaling. This kind of goes hand in hand with your pre-trade checklist. So journaling. You always want to journal your trades. You want to be collecting data at all times because that is what trading is. It is data collection. So you're going to either use your trading view as your journal. That's what I use. You can use Notion, you can use Notes app, you can use paper, you can use whatever works best for you. But you're going to want to screenshot before your trade and after your trade. So you're going to want to know what your trade looks like before you enter versus after it. And then keep it simple. Simplicity is the king here. Why you entered in one sentence. So list your confluences, list your setup, if it played out, whatever. And then at the end, did you follow your rules? Now, after your trade, you want to reflect. Did I follow my rules? Was the setup there? Were did we have a sweep to the upside and a break of the low and then that retracement, or were we missing something? So you always have to follow your rules. Having a pre-trade checklist is basically the same thing as journaling, but you want to be able to have the same pre-trade checklist every single time. Now, it could be different in different people's in different strategies, but my pre-trading checklist looks something like this. Is this a valid fib? And I can identify that by looking at price, by using my fib tool and seeing how it reacts off of the levels before I make an exact entry. Now, for me, my pre-trade checklist is pretty simple. I just look for the sweep of a high, a fake sweep of a high or a low, and if the fib that I'm using is valid, meaning the levels were respected, and then I use extra confirmations like SMTs or order flow, anything like that. So your pre-trade checklist is going to be different, but across the board for each person. I think you should be finding what's best for your trading style and making your own pre-trade checklist. I would start by paper trading and starting to get the basics down of buying and selling. And then I would start to form my strengths and my weaknesses and write those down. And then create yourself a pre trade checklist, something to follow. Now, one more thing I would like to add is that if you are just getting into trading and you understand the basics of what I've covered today, I would recommend buying the eval anyways. Now, this might be a hot take, but the psychology between paper trading and trading on your eval is going to be drastically different. When you're trading on your evaluation phase, you know that there is a lot more risk on the line. You have skin in the game, you have money on the line that you don't want to lose, as opposed to if you're just pressing buy or sell on a paper trading account. So I always recommend to those that are new to the markets and understand the basics to buy the evaluation account or a prop firm account, whatever you want to call it, and trade with small size on there and start learning your own personal trading style. Now, this will drastically improve your trading game because now that you have an eval in your trading on lower size, it helps you start to build that discretion of when to buy, when to sell, what to look for, what the patterns are, and everything like that. Now, I did miss one thing here, sessions and time frames. So this will be the last section, and then we will call it a day. Now, here in front of us are the current time zones based off of where I live in Arizona. This is when the sessions open and the sessions close. So we have New York AM at 7:30 in the morning. That ends up closing at 10 a.m. New York lunch opens up at 10 a.m. and it goes till 12. And then New York PM opens up at 12 and goes to 2. So those are all continuous. And then there's a little bit of a gap between New York PM and Asia. Now, pre-market, I wouldn't say pre-market, but the market opens back up after 2 o'clock at 4, but Asia doesn't technically start until 6 p.m. and that goes all the way up until 12. Technically 12, 1, whatever you can look at it either way. And then London would be our overnight session. Now, these sessions are important because they are times where the volume is going to be higher and it is going to be when you are looking to take a trade. And what I want you to do, your homework for the rest of tonight or whenever you watch this video, is going to be paying attention, like I told you before, to add that ICT kill zones indicator on your chart. Pay attention to what price does and reacts, how it reacts off of the session highs and lows. Now that basically covers it for the basics video of today. I appreciate you guys for watching. I will catch you guys in the next video.